Welcome to today's Explainer, where we're unpacking a highly actionable top-down master trading playbook for Monday, July 27th, 2026. Now, if you've been watching the charts this past week, you already know the market is in this highly technical, somewhat precarious state. It's exactly the kind of environment that can easily catch you off guard if you aren't prepared. So our goal today is to cut right through the noise. We're going to look directly at the data, the key levels, and the defensive tactics you absolutely need to navigate this session and protect your capital.
Here is our game plan for today. We'll quickly run through the market context, dive into the Nifty 50 blueprint, cover the Bank Nifty blueprint, highlight our intraday watch list, and finally lock down our risk management rules.
All right, let's start with Section 1, Market Context, because you really can't trade the micro levels without understanding the overarching macro pressures that are dictating the flow of capital right now. The absolute heaviest pressure we're facing comes from global cues. Specifically, Brent crude is sitting stubbornly above $100 a barrel. And look, this isn't happening in a vacuum. It's being fueled by those ongoing Middle East tensions. When you combine oil above $100 with sustained FII net outflows, it just places a massive burden on our markets. It's particularly weighing down oil-sensitive and high-beta sectors like auto and energy. This is the dark cloud hanging over the broader market today, and it's directly threatening long portfolios.
But before we map out specific price levels, we have to look at the underlying derivatives data. The put-call ratio right now is hovering around 0.70 to 0.75. Basically, we are sitting incredibly close to short-term oversold territory. For us, this PCR data is a massive clue. It signals a high probability that we might see some violent, sudden upward snapbacks during the session. The market is leaning heavily short, which means any upside momentum could trigger some really aggressive short covering.
And this is where it gets really fascinating, because we are trading a massive divergence today. The broader Nifty 50 is bleeding. It closed at 23,767, suffering through this extended 5-day losing streak where the trend is just strictly bearish. It's a textbook sell and rise market as long as it stays below 23,900. But in stark contrast, the Bank Nifty is showing some serious defensive strength. It closed positive at 56,693 and is stubbornly holding above its 100-period exponential moving average of roughly 55,900. So we have a weak, broad market, but a highly resilient financial sector. Which brings us to Section 2, the Nifty 50 blueprint. Knowing the broader trend is bearish, how exactly do we capitalize on it?
Here is Plan A, our primary short setup for the Nifty. The trigger is pretty clear. If the index pulls back up and rejects that 23,850 to 23,880 zone, or if we see a sustained 15-minute candle breakdown below 23,700, then we execute. Your entry is either right at that pullback rejection or just below 23,690 on a breakdown. From there, we are targeting a slide all the way down through 23,700 to 23,580 and potentially pushing down to 23,500. And of course, strict stop losses are absolutely mandatory here. You've got to protect your capital. We're looking at 23,925 for the pullback entry and 23,745 for the breakdown.
But hey, remember that put-call ratio data we just talked about? We have to be ready for those short covering bounces. So, if we witness a strong bullish rejection or reversal candle forming near the major demand zone of 23,600 to 23,660, then we flip to Plan B. You enter long in that 23,660 to 23,700 pocket, and you place a very strict stop loss just below that support base at 23,590. Keep in mind, this is a counter-trend strike. You are riding the short covering wave up to target 1 at 23,820 and target 2 right at that 23,900 ceiling.
Moving on to Section 3, the Bank Nifty blueprint. Let's zoom into that specific pocket of relative strength we identified earlier.
Because of its undeniable relative strength against the broader market, our primary plan for the Bank Nifty is actually to go long. The trigger is simple. The index just needs to hold and build value above the 56,400 to 56,500 support band. Your entry zone is nestled right there between 56,450 and 56,550, with a stop-loss tight at 56,150. If this support holds, we are aiming for a rapid counterstrike up to 56,900 with an ultimate target of 57,200. And that target isn't random. That is exactly where the major call riders are positioned right now.
Conversely, what goes up must eventually test resistance. If the Bank Nifty rallies but hits a brick wall and faces a sharp, undeniable rejection at that 56,900 to 57,000 ceiling, then we immediately pivot to a short setup. You want to enter right in that rejection zone of 56,850 to 56,950.
and keep a tight stop loss at 57,120. Once triggered, you're targeting a swift, hard move back down to 56,500 and potentially all the way to 56,200.
All right, Section 4, the intraday watch list. With the broad indices fully mapped out, let's arm ourselves with some specific tactical targets for the session.
I want you to notice the stark contrast in our trade biases here, which are purely driven by the data. We are executing bullish entries on ICICI Bank and Hero MotoCorp. Why? Well, ICICI is showing severe banking outperformance with a really solid put base holding it up. Hero MotoCorp, on the other hand, is demonstrating earnings-backed price action that is totally defying the broader sector sell-off. But on the exact opposite end of the spectrum, we are aggressively selling Reliance and auto heavyweights on pullbacks. They are just being crushed right now under the weight of those high crude prices and sustained FII selling. You are literally trading the fundamental divergence right there on your screen.
Now, everything we've discussed so far assumes a relatively standard opening bell. We have our triggers, we have our zones, but what if the market throws a massive curveball right out of the gate? What happens if the opening bell completely bypasses all our entry zones?
That brings us to Section 5, and honestly the most critical part of today's explainer, risk management rules. Because a solid plan means nothing without defensive tactics. So the crucial point is this. If we gap down over 100 points at the open, do not panic and absolutely do not sell blindly into support. The urge is always going to be to chase the momentum, right? But the data tells us the 23,580 to 23,620 zone is a major support level. If we gap down right into it, you must wait for 15 to 20 minutes of price consolidation. Let the market digest the gap before committing a single dime of your capital. That rule is unbreakable today.
Alternatively, what if we get a surprise gap up of over 80 points? The strategy completely shifts. Don't chase the rally. Instead, watch carefully for momentum exhaustion as price approaches that massive heavy call writing wall at 23,880 to 23,900. When you see that momentum fade at that major barrier, that is your high probability window to safely initiate short positions. And please remember, the environment we're trading in right now is becoming increasingly turbulent. The India VIX has expanded, jumping over 3 to 4% to sit between 1390 and 1410. When the VIX expands like this, the risk of intraday whipsaws skyrockets, and option decay risk becomes significantly elevated. Therefore, our tactical rule for today is non-negotiable. You must prioritize defined risk-hedged strategies. Stick to bear put or bull call spreads, and heavily avoid exposing yourself to unhedged, naked options. The market is just way too volatile for unshielded risk today.
Which leaves us with this final thought as you prepare your screens for the day. With heavy macro pressure mounting, the broader index bleeding, and volatility visibly expanding, are you going to let the market dictate your day, or are your defense lines fully prepped and hedged for the opening bell? Understand the blueprints, respect the risk rules, and always trade the data. That wraps up today's explainer. Stay sharp out there.